We've looked at the cash transactions, and now we're going to expand the credit transactions that you've done in grade 9, plus then new ones in grade 10. The important thing is to know in which journal. Very often we will combine at the end the cash and the credit transactions. So when you read the transaction, you must decide for yourself in which box, in which journal must we put it. And then you ask yourself the question, did we receive money? Did we pay money? Did we pay from the petty cash? Did we buy on credit? Did we sell on credit? Did we return to creditors, or did the debtors return to us? So those are the questions that you ask yourself to determine in which box it must go, in which journal it must go. So we're looking now at the credit journals. The debtors journal we use whenever we sell on credit. So whenever you read the transaction, and remember to read the transaction up to the last word. If we sell on credit, it's in the DJ. If we buy on credit, it means it must go into the CJ, in the CJ box, or the creditor's journal. If the debtor return goods to us, remember we only sell goods, trading stock, on credit. And if the debtor returns some of those goods, it's debtor's allowance journal, and then the creditor's allowance journal when we return to our creditors. We buy a variety of items on credit. We can buy trading stock, we can buy stationery, we can even have repairs done on credit. So a variety of things that we buy on credit, therefore a variety of things that we can return to our creditors, not just trading stock. Source documents involved in these journals. In the debtors journal, we have the duplicate invoice. Now, these days, we actually only have the originals because both will be printed. So it won't look like a duplicate, it will look like an original. But it's the invoice. We sell, we give away the original, we keep the duplicate. Creditors journal, we are buying, so we receive the original invoice. When a debtor returns goods to us, we will issue a credit note. In the debtor's allowance journal, we issue a credit note. Why? Because our debtors, which is an asset, will be credited. Because the debtor returned goods, now we inform them that we are going to credit their account, we're going to decrease. Yes, they will send us a debit note to say that they're going to debit our account because we are accrediting their books. But we look from our point of view. Therefore, we will send them a credit note. The same with the creditor's allowance journal. We will send our creditors a debit note because creditors, which is a liability, will decrease on the debit side. So we inform our creditors that we are going to debit their account by sending them a debit note. Yes, they're going to reply with a credit note because we are indebted to them, but we look from our point of view. We send them a debit note. So those are the source documents involved. In the CRJ, we've got cash register roll, we've got a receipt, we've got an EFT payment, we've got the bank statement. And in the CPJ, we have the EFT payments that we made as well as the bank statement that can be source documents. And obviously in the petty cash journal, it will be the petty cash voucher, the little piece of paper that explains what we paid for out of the petty cash. If we've gone through all the boxes, CRJ, CPJ, DJ, DAJ, CJ, CAJ, and it doesn't go anywhere, it doesn't fit in any of those journals, we put it in what I call the man drawer. We all have a drawer like that in our homes, the one that we just put in all the extras. It doesn't fit anywhere else. And then we've got this general journal, this general drawer where we just put in all the bits and pieces. And this is called the general journal. Transactions to be shown there. Certain ones most of them, we know exactly which account to debit and which account to credit. In bad debts, we debit bad debts. How do we know that? Because owner's equity decreases. It's an expense. And we credit the debtor. This is an asset that decreased. The debtor can't pay us anymore. So it doesn't make sense of keeping that debtor in our books. We write that off as bad debts. Debit bad debts, credit the name of the debtor. Interest paid, we are overdue with paying our account to the creditor. So they charge our account with interest. Interest paid, that is an expense, so my owner's equity will decrease. And the creditor, AB Traders, is a liability that will increase. We owe them more because we are in arrear with paying our account, therefore they charge our account with interest. In the same way, if a debtor is overdue on paying their account, we will debit the debtor. They owe us more, and we credit interest received. Interest received, which is an income that will increase owner's equity. Smith is a debtor, it's an asset that increased. If the owner takes something for his own use, we know we always debit drawings. Drawings to be debited because owner's equity decreases. And then we credit whatever he takes. If he takes cash, it's a CPJ entry, we credit bank. But if he takes trading stock, we credit trading stock. If he takes stationery, we credit stationery. Trading stock, asset that decreased. Stationery is an expense that decreased, therefore owner's equity will increase. Second last one, whenever the owner gives capital, anything else than cash. Obviously, when he gives cash as capital, we debit bank and we credit capital. But now he gives a vehicle. So we debit vehicles and we credit capital because our assets in the business will increase and the owner's equity will also increase because the owner invested more, not money, but a vehicle with a certain value. And then the last one, where we don't have a specific account to be debited or credited, is the correction of errors. And there you read, what was I supposed to do? Which account was I supposed to debit or credit? Then you do what was the right thing to do and you just credit or debit the other amount. So there you have to read very carefully. And then you're going to use your T accounts in order to determine which account to be debited or credited. The next activity that we're going to do is where we post from all the journals, including the general journal, just not the petty cash journal, but all the journals to the ledger accounts and also completing the general journal. And that is activity 7, page 15 and 16 in your activity book, and page 21, 22 in your answer book. They give us information relating to Kulisi traders, and they use a markup of, again, 50% on cost price. We first have to do the general journal. We don't have to show the narrations. Now, the narrations is just a sentence that we write below to explain what we are doing with the journal entry. And then we must post to these accounts. Now, I want you to add debtors control. They only say trading stock, creditors, and stationery, but I want you to add a debtors control account there. And then also add the balance there to the balances given on the 1st of October, debtors control 18 to 60. If we look at the journals, now again, the principle of accounting equation. In the CRJ, we receive money. So bank is an asset that will increase. So bank will be debited. All the rest will be credited, except for discount allowed, because that's not money received, and cost of sales, because that's also not money received. So whenever transaction says we receive money, we know we debit bank. And then we credit the other account. So to calculate that bank amount, we've received 8,540 from the debtors. We've received 19,200 from cash sales, and we received 4,500 in the sundry accounts, other things that we received. So the total receipts 3,240. Cost of sales. They've given us sales. We want to know the 100. They gave us the 150. Therefore, cost of sales 12,800. In the CPJ, we pay money. So in the CPJ, we credit bank. This is an asset that decreases, so we credit bank. And we debit all the rest except for discount received. This is not money that we paid. So if we have to calculate trading stock, we've paid 21,040, of which wages was 3,800, creditors 7,040, and sundry accounts 4,200. Therefore, we bought trading stock for 6,000. They told us that stationery of 330 was paid on the 23rd. So when we post to the stationery account, we must remember we bought stationery cash on the 23rd of October, and that is included there in the sundry accounts. Debtors journal, they've given us sales and cost of sales, debtors allowance. There you can see these two journals look the same. Selling price, cost price, selling price, cost price. But instead of sales in the debtors allowance, we have debtors allowance. Creditors journal, we are buying on credit. Therefore, creditors control, it's a liability that increases. Therefore, we will credit creditors control, and we will debit the rest. So whenever there's a question, theory question, account to be debited and credited, if I buy on credit, we credit creditors control and debit whatever we bought. Creditors allowance journal, now we are returning what we bought. So creditors control, which is a liability, will decrease. So therefore we will debit that, because we know liabilities decreases on the debit side. And we will credit the rest. The general journal, they've given us the totals for debtors control and creditors control. Whenever we debit a debtor or a creditor, we must make an entry on the control account as well. The control account refers to the summary of all our debtors, all our creditors, while in the list it refers to individual debtors or creditors. We first need to do the general journal. So these 5 transactions to be entered in the general journal. The first one, Sia Kulisi, who is the owner, took stationery and trading stock for personal use. This was on the 31st of October. This is October, not February. Just change that in your answer book. The owner took something. Whenever the owner takes something for own use, we know we debit drawings. And we credit whatever he took. He took stationery and he took trading stock. Stationery to the value of 130 Rand. And then we must calculate the cost price. Because whenever the owner takes or whenever we donate trading stock, it's always at cost price. Selling price, we want to know the 100, we want to know the cost price. We've got the selling price, the 150. So then we know the cost price of what the owner took was 640. So trading stock, 640. And in total, that will give us the drawings of 770. None of those refer to a debtor or creditor, so we don't write anything in debtors control or creditors control. The next one, C, Candace, a debtor owing 430, has to be written off as irrecoverable. For some other reason, this debtor will not be able to pay us. So we write that off as bad debts. We know we must debit bad debts, and we credit C, Candace. The amount is given, 430. And now Candace is a debtor that was credited, therefore the debtors control account must also be credited. In the debtors ledger, we will credit Candace's account and the balance will be 0. But we must also show that in the debtors control account. The next one, Kulisi Traders, that's us, failed to pay the account of 8820 to number 1 dealers on time. And interest for 2 months at 10% per annum must be brought into account. So we owed 8,820 Rand. Now they charge us with 10% interest for 2 months, multiply by 2 on 12. So the amount of interest that is charged to our account is 147. Interest paid is an expense, so we must debit interest paid and we credit number 1 dealers because this is a creditor that increases. 147, 147. Number 1 dealers, a creditor that we credited, therefore creditors control 147. Can you see the whole time I refer to which account to be debited, credited by means of this is an expense, owner's equity will decrease, that's why we debit. Candace is a debtor which is an asset that will decrease, that's why we credit. Those 3 entries, sort of that is what we debit, that is what we credit. But the last 2, correction of error, that means you must think. Repairs of 20,000 was done to the roof of the store's building. This was entered in the land and buildings account in error. Repairs were done. We were supposed to debit repairs. So that is what we do. The right thing. We debit repairs. And then we credit whatever we debited by mistake, land and buildings. And that was an amount of 20,000. We debited land and buildings by mistake. Now we credit that. We just take it out. We cancel it. Repairs, expense that decreases owner's equity, that must be debited. None of those refer to a debtor or creditor, so nothing there. And the last one, Be Patient, whose account was previously written off as bad debt, returned from overseas and settled his outstanding account of 1,250. And it was entered in the debtors control column of the cash receipts journal in error. and post it as such. Remember what I told you? We ask ourselves, what were we supposed to do? We received money, we debited bank. That's fine, we did that. We were supposed to credit bad debts recovered. So that is what we do. We credit bad debts recovered because it's an income account. Bad debts recovered. And then we debit the wrong one. Be patient. We credited Be Patient's account. That debtor didn't exist anymore. Now we're going to credit it. That means we owe them 1,250. That doesn't make sense. That's why we debit Be Patient so that his account will be zero again. And we credit bad debts recovered, which is an income. Be Patient is a debtor that we by mistake credited and now we debit. Always remember, when we do general journal entries, the account that you write first is the account to be debited. And the account that you write second will be the account that you credited. Now we at the end of the general journal, we add up these to get the journal debits and credits. 1740, 666. That one stays 630. And the total 447. And now we can start by using the journals given, CRJ, CPJ, DJ, DAJ, CJ, CAJ, as well as the general journal to post to the ledger accounts. Trading stock account is always a nice one because the trading stock account, all the journals will go into the trading stock. Trading stock asset that will increase on the debit side, decrease on the credit side. Everything in the trading stock is shown at cost price. So whenever we put an amount in there, it must be the cost price. We can never put selling price in there because then we've got a fruit salad. Cost price, selling price, which is it now? Always cost price. What I'm trying to teach you now is to figure out what this account must look like without just studying it, without understanding what it means. Trading stock is an asset. Therefore, it must have a debit balance. October the 1st, we started with a debit balance, brought down 28,000. That was given. Trading stock will increase. When will it increase? It will increase when we buy. We buy in the CPJ and we buy in the CJ. We can also buy trading stock in the petty cash journal. Petty cash journal was not included here. Then our stock will also increase when the debtors return trading stock to us. That will cause our trading stock to increase. Obviously, if we made mistakes in the general journal that was corrected, that will also go in here. Our trading stock will decrease when we sell. We sell cash in the CRJ. We sell on credit in the DJ. It will also decrease when we return trading stock to our creditors. And then we had this one where the owner took trading stock for his own use in the general journal. DAJ, DJ, always on opposite sides of an account. The same with CJ and CAJ. They can never be on the same side of an account. They must always be on opposite sides. In the CPJ, we debit trading stock and we credit bank. That's the contra account. In the CJ, we buy and credit. We debit trading stock. We credit creditors control. In the debtors allowance journal, the debtors return trading stock at cost price, cost of sales. In the CRJ, we sell cash, but we sell at cost price, cost of sales. This is all on October the 31st. In the DJ, we sold on credit. The trading stock decreases at cost price, cost of sales. Creditors allowance journal. We credit trading stock because we returned that, and we debit creditors control because it's a liability that decreases. And then in the general journal it says credit trading stock and debit drawings because the owner took trading stock for his own use. We know that trading stock will always have a debit balance. So the debit side will always be more than the credit side after October, November the 1st, the balance brought down. Now where to find the amounts? That's the next challenge. We are busy posting to the trading stock account. In the CRJ, the first thing that we look for is trading stock. We don't have trading stock in the CRJ, but we have cost of sales. CPJ, we're looking for trading stock. In the DJ, there is no trading stock, but there's cost of sales. The same with debtors allowance, cost of sales. In the CJ, we have trading stock column total. CAJ, we have trading stock because we are busy posting to the trading stock. And in the general journal, we had the owner that took trading stock for 640. So we're looking for trading stock. If we cannot find trading stock, then we look for the next best, and this will be the contra account, cost of sales in those cases. So if we put in those amounts, 6,000 cash, we bought on credit, debtors returned to the value of 200 Rand. If we add that, it gives us 42,000. We sold, cost price of 12,800. We sold on credit, cost price of 10,200. We returned to creditors, the owner took at cost price. So if we subtract those four from the 42,000, then we get the balance of 17,460. Debtors control. That's the one that you had to add. It's not in your answer book. Please add that. It's an asset. Therefore, we will start with a debit balance. And I've given you the debit balance, 18,260. Our debtors will increase when we sell on credit. We sell on credit in the DJ. They will also debit journal debits in the general journal. Our debtors will decrease when we receive money from them. But they will also decrease with a discount that we allowed, also in the CRJ. They will decrease when they return goods in the DAJ. And then we have the general journal. We know the debit side must always be more than the credit side. Therefore, we know we will have the balance carried down, and then November the 1st, we will have the balance brought down. Now we can start looking for the amounts. In the DJ, we have a debtors control column. They owe us the selling price. Sales, 15,300. In the general journal, we know it is journal debits, and that total that we've calculated, 1740. In the CRJ, we're looking for debtors control, the amount that we received from them, 8540. In the CRJ, the discount that we allowed. In the DAJ, the account to be debited will be debtors allowance. And we have a debtors allowance column, 390. And in the general journal, our journal credits, and we've calculated that as 666 Rand. We add the debtors control, 35,300. The debit side must be more. If you post to your debtors control account and your credit side is more than debit side, you know somewhere you made a mistake. And this is 25,404. Just to show you where we look for these amounts, if we start with a CRJ, in the CRJ, debtors control the amount that we received as well as the discount that we allowed. No debtors in the CPJ. In the DJ, we sold, so that's how much they owe us. That is what they returned. Creditors journal, creditors allowance journal, obviously nothing to do with the debtors. And then in our general journal, journal debits, journal credits. So there you have the amounts that you post to the debtors control account. Creditors control, now we must remember creditors is a liability. So it will increase on the credit side, decreases on the debit side. Therefore, it must start with the credit balance, always. 15,430 given. Now the creditors will increase when I buy on credit, and I buy on credit in the CJ. They will also increase with the general journal. Our creditors will decrease when we pay them. We pay in the CPJ, but we also receive discount in the CPJ. Our creditors will decrease when we return items to the creditor. And then we have the general journal. What did we buy on credit? Sundry purchases, a variety of items that we buy on credit. Not just trading stock, can be repairs, can be stationery, packing material, anything that we bought on credit. Journal credits. We paid our creditor. We credit bank and we debit creditors control. We receive discount. Discount received is an income. Discount received. Then we return. What did we return? A variety of items. Sundry returns that we returned. We can't just write the name of one account there because it's a variety of items that we return. And then in the general journal, journal debits. In the CJ, we bought on credit 12,200. Journal credits, we've calculated 447. In the CPJ, we paid our creditors 7,040 and we received discount of 340. We return items to the value of 2,400 and then our journal debits 630. We know the credit side must be the most, so we add up the credit side. Once again, if your creditors control ends up with a debit balance, you know somewhere you made a mistake. 28,077 minus those will give you the balance. Carried down 17667 and after October is November, and the balance brought down 17667. Just to show you where we got these amounts from. CRJ, nothing of the creditors. In the CPJ, we paid our creditors 7040 and we received the discount. We said we credit bank and we've debited creditors control. DJ, DAJ, nothing regarding creditors. Creditors journal, we bought on credit, so we credit creditors control. Creditors allowance, we returned, therefore we debit creditors control. And in the general journal, it was these two totals, journal debits, journal credits. The last account there, stationery, which is an expense account, and we know that expenses will have debit balances. So we start 2021, October the 1st, balance for stationery given as 670. Stationery will increase when we buy cash, when we buy on credit, when we buy from the petty cash. So it can also be PCJ. Our stationery will decrease when we return to our creditors. And in this case, if you remember, the owner took stationery for own use. And then if you can also remember, when we bought in the CPJ, it told us it was on the 23rd. There wasn't a column for stationery in the CPJ. It's included in the sundry accounts. When we buy cash, we credit bank, so the contra account is bank. When we buy on credit, the contra account is creditors control. We've returned stationery. We credit stationery and we debit creditors control. We bought stationery, cash to the value of 330, on credit 700, we returned to the value of 300, and the owner took stationery to the value of 130. Just to show you again where we got these amounts from, remember we are posting to the stationery account. So we're looking for stationery. Nothing in the CRJ. In the CPJ, stationery 330, and that was the one on the 23rd. DJ, nothing on stationery. In the creditors journal, we bought on credit. CAJ, we returned stationery. Yet again, I've indicated that we credit the rest. There we debited the rest. And then in the general journal, the owner took stationery for own use, so we credit stationery with what? With drawings. I really hope that this helps you with understanding your general journal accounts, and not just by trying to memorize that and remember that in the test or exam, but really to figure it out, to understand, to logically think which account to be debited and credited, and also important, where to find those amounts in your journals.